An AI found a bug in a blockchain protocol that could have allowed someone to print unlimited money undetected for 4 years.
Separately, a European stablecoin issuer was hacked. The attacker created $13.5 million worth of tokens out of thin air and walked away with nearly $3 million before anyone could stop them.
And in just over a week, the EU will cut off every crypto firm that isn't fully licensed from operating across its entire market.
The infrastructure is building, but this month reminded everyone that trust has to be earned, not assumed.
Welcome to The Signal, Episode 2. I'm Maryam, and this month the questions got harder. Not because the numbers went up, because the security incidents are getting more expensive.
Tari, and I agree, we have growth stories this month, significant ones, but we also have 2 security incidents that cut straight to the question everyone who works in this space has to be able to answer. Why should anyone trust this?
We're going to try and answer that honestly. Let's start with the numbers. Binance Research published its monthly market insights earlier this month. The headline, active tokenized real-world assets have grown 589% from the start of 2025 to June 2026. Tokenized stocks up 422%. Bonds and money market funds up 83%, adding $6.5 billion in value.
And their framing of that is interesting. They basically argue that 2026 marks the shift in real-world assets tokenization from tokenized treasuries being the main story to a much broader range of income-generating assets coming on-chain.
Which is a significant shift. Episode 1, we talked about the 30 billion figure and how most of it was US government bonds. That is still the biggest category, but the composition is changing. Tokenized stocks, real estate, commodities, private credit, all of them growing faster in percentage terms than treasuries. The market is not just getting bigger, it's getting broader.
On the global markets, the platform that was part of the JP Morgan settlement story we covered last month crossed $1 billion in assets on the platform within 8 months of launch. Kraken launched tokenized SpaceX stock and has crossed $25 billion in cumulative trading volume on its tokenized equities platform. Goldman Sachs partnered with Arches to launch a tokenized real estate fund on its digital asset platform. That's quite a range of assets.
Each of those on their own would have been a significant story 2 years ago. Right now, they're footnotes in a monthly roundup. That tells you something about the space, and there's one more this month that ties the infrastructure thread together. Securitize, the largest iRWA tokenization platform by market share, the firm that runs the rails beneath BlackRock's BUDL fund, Apollo, BNY Mellon, and 1x, cleared its final SEC hurdle on June 5th for a public listing on the New York Stock Exchange. The shareholder vote is the day this episode goes live, June 29th. If it passes, Securitize lists as SEC-Z, making it the first major iRWA tokenization platform to trade on a traditional stock exchange. The infrastructure that carries tokenized real-world assets is itself entering public markets. Watch the ticker.
Last month, we quoted 792,856 holders from iRWA.xyz as of May 18th.
So we had to check again ahead of today's recording. As of June 23rd, the figure is 930,612.
That is an increase of over 13% in 30 days.
And that rate of growth matters more than the absolute number. To go from roughly 790,000 to 930,000 in a single month means this is not a slow drift upward. Something is accelerating. New asset types, new platforms, easier access pathways, all of it bringing in a different kind of participant. Ondas OUCG product is the clearest example. People holding tokenized US treasuries purely for the yield with no interest in crypto as a concept. They came for a 5% return on a dollar-denominated asset. The blockchain underneath is invisible to them.
When we started episode 1, I said the entry point for blockchain is no longer speculation, it is yield. Looking at this number, I think that the trend is becoming harder to ignore. More people are arriving because they want access to assets that generate income, not simply because they have hope prices go up.
This one is not a market figure, it's a deadline, and it falls between us recording this and most probably you hearing it. On July 1st, 2026, the EU's MiCA transitional period expires. After that date, any crypto exchange, broker, or wallet provider that is not fully licensed cannot legally serve EU clients. No more operating under national registrations, no more grandfathering, full stop.
And what is the current state of authorization?
Only around 210 of the more than 1,200 firms that held pre-MiCA national registrations have converted to full CASP authorization. That is roughly 17%. The remaining 83% either cease operations in the EU, withdraw from the market entirely, or have been quietly working through applications that are still pending. But ESMA has been very explicit that a pending application does not protect you from enforcement after July 1st.
So for someone using crypto platform in Europe, what does this actually mean in 2 days?
Practically, some platforms will begin blocking new deposits from EU users. Others will force account migrations to licensed entities. Others will simply pull out of certain EU countries entirely. France, for example, they have been very strict. They are already mandating cessation of operations for unlicensed firms. The consolidation that has been building for 18 months is about to happen very fast.
And for the firms that have already done the work to become compliant, this could be a significant advantage. The unlicensed players clearing out of market creates space.
That is the other side of it. Enforcement clears the field, and the firms left standing will have EU-wide passporting rights. One license, 27 EU member states. Although it's worth being precise, Switzerland, Norway, and the UK, they each operate under their own separate frameworks and are not covered. That is a significant structural advantage.
You mentioned the UK earlier when you talked about MiCA, that it sits outside the framework. So what is the UK actually doing?
Good question. And the timing could not be more relevant. So if we go back, on April 21st, during London FinTech Week, Asian Treasury made a significant policy reversal. And with the EU's July 1st deadline a few days away, it now looks less like a coincidence and more like positioning. The UK government previously indicated it would not bring qualifying stablecoin payments within the regulated perimeter for payment services. In April, it reversed that position entirely. Stablecoins used for payments, where the issuer is authorized under the new qualifying stablecoin issuance framework, will now be regulated as payment services.
What does that mean in practice?
It means that if you're a UK authorized stablecoin issuer and someone uses your token to pay for something, that payment is now a regulated activity, subject to the same consumer protection frameworks, the same dispute resolution mechanisms, the same safeguarding requirements, just as your regular Visa payment or a bank transfer. That is not a small thing. It's the legal architecture that makes stablecoins genuinely usable in everyday commerce rather than just as trading instruments.
And with MiCA now forcing firms to choose a compliant EU jurisdiction or leave the European market, the UK has positioned itself as a credible alternative. A framework that is structured enough to attract institutions, but still outside some of MiCA's specific restrictions, including the transaction caps on non-euro stablecoins.
That is exactly the window the UK is positioning itself to fill. And it's worth noting that the UK framework is expected to favor GBP-denominated stablecoins, which MiCA does not cover at all. That is a deliberate carve-out for sterling-based digital payments, and it signals where the FCA wants to see innovation happen. The StablR hack we are about to cover happened in Europe. The UK's announcement happened in April. That means that the regulation arrived in April and the risk materialized a month later. And now the July deadline has made both of them land harder than they might have otherwise.
Which brings us to the number I think is the most important one to sit with this month. $2.8 million. That's what a hacker walked away with after exploiting European stablecoin issuer StablR on May 26.
The mechanics: StablR operates USDR, a dollar-pegged stablecoin, and EURR, a euro-pegged stablecoin. Their minting infrastructure used what is called a one-of-three multi-signature wallet, meaning a single authorized signer could approve a transaction. The attacker compromised one private key, added themselves as an admin, removed the legitimate operators, and minted roughly 8.35 million USDR and 4.5 million EURR that have no backing whatsoever.
18.5 million is unbacked tokens created from nothing.
Yeah, then they tried to sell those tokens on decentralized exchanges, and this is where it gets interesting. In liquidity, the fact that not enough buyers existed at those prices limited what they could actually extract. They walked away with around 1,115 Ether, worth approximately 2.8 million at the time.
Can you briefly explain why liquidity ended up acting as a defense mechanism here?
Well, when you create tokens out of nothing and you try to sell them, you still need buyers. A decentralized exchange works through liquidity pools, essentially shared reserves of assets that facilitate trades automatically. The attacker dumped a large amount of newly minted USDR and EURR into those pools simultaneously, but the pools did not have enough depth to absorb that volume without price collapsing. So every token they sold pushed the price down further, which meant the next batch was worth even less, and so on. The tokens existed on paper, $13.5 million of them, but the market structure physically could not convert them into that amount of real value. So liquidity was not a deliberate defense, it was an accidental one, and it is worth noting. On a deeper, more mature market, the same attack could have extracted significantly more.
What happened to the tokens?
StablR froze both tokens, suspended minting and redemption, and asked exchanges to halt trading altogether. The dollar-pegged USDR has largely recovered since then, but the euro-pegged EURR is still trading at roughly 70% below its intended peg at the time of recording. Whether affected users will be made whole and how is still unclear.
The security firms who analyzed it, Block8 and GoPlus, were clear that this wasn't actually a flaw in the smart contract code itself. It was a management failure. In other words, a problem with the security setup around the system, not the system itself.
Which is actually an important distinction. The code worked as written. The problem was the governance around who could use it. I want to use the two security stories from this month, StablR, which we covered in the numbers, and something we have not addressed yet, to have the conversation that I think people who are serious about this space need to have openly, because both of them raise the same underlying question. Why should anyone trust this infrastructure?
Well, let's start with the second one, because it is the stranger one.
Yeah, on May 29th, a security researcher named Taylor Hornby discovered a critical vulnerability in ZCash's Orchid privacy pool. ZCash, for those unfamiliar, is a cryptocurrency built specifically for anonymity. Transactions are designed to be untraceable. The Orchid pool is the most advanced layer of ZCash transaction infrastructure, and it's active since May 2022. A vulnerability that would have allowed an attacker to mint an unlimited amount of counterfeit ZCash's native token, with no one able to detect it. He found it using Claude Opus 4.8, Anthropic's most capable publicly available model at the time. Since then, Anthropic has released Claude Mythos, which goes further. 24 hours, nevertheless, of that model's release, he had found a 4-year-old bug that had survived multiple rounds of review by world-class cryptographers.
But this one is one of those stories where we probably need to be direct.
Agreed. And I think the significance is not that Claude found the bug. It is what that means for every other protocol that has not yet had someone like Taylor Hornby run the same exercise on their code.
Can you explain what the vulnerability actually was?
ZCash's Orchid tool uses zero-knowledge proofs, a form of cryptography that allows you to verify that a transaction is valid without revealing the amounts or the participant. The bug, a specific validation check that was supposed to enforce the rules of the transaction, was not actually enforcing those. An attacker who found it could feed false inputs into that check, have it pass anyway, and generate ZEC from nothing, with the cryptographic proof system certifying the fraudulent transaction as legitimate.
And nobody knew?
Nobody knew. Warren Buy built the working exploit in his local environment. It worked. He disclosed it to the ZCash team rather than running it on mainnet, which is what separates a white hat researcher from an attacker. The team deployed an emergency fix by June 1st, but here's what is genuinely unsettling. Because Orchid is a privacy tool, there is no cryptographic way to determine whether this vulnerability was exploited between May 2022 and the fix in June 2026. The same privacy properties that make the protocol valuable are the properties that make prior exploitation undetectable.
So we genuinely do not know if someone was already using it.
The ZCash team assessed prior exploitation as unlikely. The bug required very sophisticated discovery, the remediation window was narrow, and there were no anomalies in the supply data they could detect. But they were very explicit. That assessment is probabilistic, not certain. But let's say what is actually being implied here, because I do not think we should leave it out. If Taylor Hornby found this in under 24 hours using a model that was released to the public, what has someone with the same tools and different intentions been doing? This is not a hypothetical. AI at this capability level is publicly available. The capability that found the ZCash bug is not restricted to white hat researchers or security firms with deep pockets. It is available to anyone with internet connection and the knowledge to use it. And that means every crypto protocol team needs to sit with a very uncomfortable question. Has someone already run this exercise on our code and not told us about it?
So this isn't really a Zcash problem. It's potentially an industry-wide problem.
Yeah, the Zcash case makes this particularly sobering because of the privacy architecture. There is no way to audit whether that vulnerability was exploited in the 4 years it existed. That is specific to Orchid's design, but the broader principle holds everywhere. If a black hat actor found a critical vulnerability quietly and exploited it, the evidence might be undetectable or only visible years later when it's far too late. Pandora's box is the right frame. This capability is out. It cannot go back in. The attack surface across every blockchain protocol grows every time LLMs get smarter. Defenders now have to move faster than the attackers, and most protocols are not moving fast enough.
So the responsible disclosure from Hornby is not just good news, it is a warning shot.
It is exactly that. And the team that treat it as one will be in a very different position in 12 months than the ones that don't.
Okay, so we have 2 incidents in the same month. One is a governance failure. The other one is a sophisticated cryptographic vulnerability found by AI. What's the common thread here and what it means for this space?
Both of them are trust problems, but they're very different kinds. The StablR hack is a problem that existing financial regulation already knows how to address. Custody requirements, operational security standards, multi-party authorization, thresholds. The UK announcement we covered previously is exactly the kind of regulatory architecture that would require higher security standards from stablecoin issuers. A one-of-three multi-sig wallet would not pass under serious regulated payment services framework.
So that hack is an argument for regulation, not against the technology.
Exactly. The ZCash story is harder because there is no regulatory framework that would have found the bug. It took cutting-edge AI tooling in the hands of an expert. The implication, and this has been noted widely by the observers in this space, is that every crypto protocol is now on notice. The tools available to attack are improving at the same rate as the tools available to the defenders. Every protocol needs to be proactively looking for its own vulnerabilities before someone else does.
So that's more of an infrastructure challenge than a regulation challenge.
Right. And it's worth being honest that the assets being tokenized are real bonds, real estate, equity stakes, but they live on blockchain infrastructure. If the infrastructure has vulnerabilities, the assets are exposed. The institutional interest in RWA is real and growing. The scrutiny of the infrastructure it runs on needs to grow at the same pace.
That is not a reason to stop. It is a reason to take security seriously at every layer.
Which is exactly what the good actors in the space are doing. The ZCash response was a model of responsible disclosure and fast remediation. StablR's freeze and suspension was the right call, even though it was painful. The institutions that have moved into this space, JP Morgan, Morgan Stanley, BlackRock, they all have security and operational risk factors that would not allow the kind of setup StablR was running. The question is whether the standards of the institutional players become the floor for the entire space.
And regulation is one mechanism for making that happen.
It is the primary mechanism, which is why July 1st matters so much.
3 regulation threads this month, very different in nature.
Giver, July 1st is the headline, but the detail matters. MiCA full enforcement means that in 2 days from when you are hearing this, June 29, roughly 83% of firms that held pre-MiCA national registrations will either be licensed in the process of winding down or in breach of EU law. The consolidation effect is real and intentional. ESMA wants a smaller number of well-capitalized, properly supervised providers operating across the bloc. The firms with full CASPA authorization and EU passporting rights are entering a less crowded market. For consumers, check your platforms. If you're using a crypto service in the EU and have not heard anything about MiCA compliance from them, that silence is worth investigating.
The April 21st announcement we covered earlier is becoming more relevant by the day. The reversal on stablecoin payments regulation signals that the UK is actively positioning itself as a hub for regulated digital finance post-Brexit. The FCA is expected to publish final stablecoin framework rules later this year. For companies looking at where to build compliant stablecoin infrastructure outside the EU, London just became a lot more interesting.
US, the Clarity Act. It's still in the Senate. Congress came back from recess without a floor vote scheduled. The Ethics Amendment, the conflict of interest clause around government officials holding crypto assets, remains the active fault line. The July 4th signing scenario has essentially passed. Autumn is now the realistic target for a floor vote. The 60 to 70% odds of 2026 passage we quoted last month have not materially changed, but the timeline has stretched. Meanwhile, every month the US spends without a framework, other jurisdictions are writing the rules that global capital is beginning to follow.
The divergence between the three is actually the story. Europe is enforcing hard, the UK is signaling openness, the US is still negotiating. Capital and talent tend to follow those signals.
Before we go to iRWA section, I want to address something that is not strictly an RWA story, but that I think is impossible to ignore this month. And that connects to almost everything we have discussed, particularly the AI conversation we just had, the SpaceX IPO.
The largest IPO in history.
On June 12th, SpaceX listed on the Nasdaq at $135 a share, raised $75 billion, more than double the previous record held by Saudi Aramco, and closed its first day up 19%, crossing a $2 trillion valuation. Elon Musk, who said in the early days of the company he gave it less than a 10% chance of succeeding, is now the world's first trillionaire. And the reason investors are pricing it at $2 trillion has very little to do with rocket.
It is an AI story.
It's almost entirely an AI story. SpaceX merged with xAI earlier this year. The majority of its capital expenditure, $10 billion in the first quarter alone, is going into AI infrastructure, which remains for now the least profitable of SpaceX's three business segments: space, Starlink, and AI. And the specific bet at the heart of the company's valuation is the plan it filed with the FCC in January. Up to 1 million satellites in orbit, each functioning as an AI data center powered by continuous solar energy in sun-synchronous orbit, cooling their GPUs using the cold vacuum of space rather than water.
Which sounds like science fiction until you realize the underlying problem it is trying to solve is very real.
Yeah, the United Nations published a report this month that I think needs to be taken seriously. By 2030, data centers powering AI are projected to consume 945 terawatt hours of electricity, nearly triple the combined annual electricity use of Pakistan, Bangladesh, and Nigeria. Their water footprint will equal the basic annual domestic water needs of every person in sub-Saharan Africa. Researchers in South Africa have been raising specific concerns about the impact on local freshwater resources as hyperscale data centers expand into the continent. The cooling systems that keep AI running on Earth are not abstract. They're depleting real rivers in real places.
And from where I'm sitting in China, this is not a distant concern. The digital infrastructure built out across Asia is enormous. Data centers are being constructed at a scale that puts genuine pressure on water and power grids in regions that are already water stressed.
So when SpaceX says the solution is to move the compute off Earth, to build data centers in space where there is unlimited solar power and the cold of space handles the heat, that is not a publicity stunt. It's responding to a real constraint. And I think this is why the IPO was the success it was. People are not just buying a rocket company, they are buying the idea that the sustainability ceiling on AI compute is not actually ceiling.
But SpaceX itself acknowledged in its own IPO filing that orbital AI is in early stages of significant technical complexity and may not achieve commercial viability.
Which is the honest version of this story. 1 million orbital data centers is an extraordinary ambition. Astronomers are already raising concerns about what that constellation does to the night sky. Space debris at that scale raises serious long-term questions about the viability of low Earth orbit, and GPU failure rates in the radiation environment of space are estimated at roughly 9%, far higher than on the ground. SpaceX is betting that Starship brings launch costs low enough to make the economics work. That may happen, it may not.
So why raise it on a short but reward assets?
Because the world we are describing, tokenized bonds, programmable money, digital participation, AI-found vulnerabilities, stablecoins, payment infrastructure, all of it runs on compute. The digital economy is not ethereal, it's physical. It runs on servers that need power and water. The sustainability of that infrastructure is the sustainability of everything. When Musk bets $2 trillion on moving that infrastructure to space, that is not separate from the conversation we're having. It's the foundation of it.
And if it works, the constraint disappears?
If it works, the constraint disappears. That is the bet. And whether you think it's genius or hubris probably depends on whether you have been paying attention to what he has built or promised to build before.
Last month, we described iRWA as asking what should flow through the pipes the institutional world is building. 9 months in, the ecosystem is starting to answer that question in concrete terms.
When iRWA launched, it had just one project. Today, it's 22 and more are coming. That kind of growth in less than a year is worth pausing on because it does not happen by accident.
So what has made it possible?
A few things converging at the right moment. The institutional world, as we have been covering for 2 episodes now, has spent the last 18 months proving that on-chain infrastructure works and the regulatory frameworks can be built on top of it. That legitimizes the entire category. When JP Morgan settles the Treasury's transaction in 4 seconds and Morgan Stanley launches a tokenized wallet, it becomes easier for a project dealing in cultural assets or community participation to walk into conversation and be taken seriously. The institutional layer creates the credibility umbrella.
But iRWA is not competing with JP Morgan for that institutional layer. It is doing something different.
Entirely different. The projects joining iRWA are not tokenizing government bonds. They are tokenizing things that have never had a financial infrastructure around them at all. Creative works, communities, participation, intangible value. What has made the growth possible is that the builders in those spaces have been watching the infrastructure mature and waiting for the moment when the tooling was just right, was serious enough to trust. That moment is now. Octagram, builders with 16 years of real-world experience, joining this month is a signal of that. These are not experimenters, they are practitioners who have decided the infrastructure is ready.
And the Dalí project is perhaps the clearest example of what that looks like.
Our team, Professor Alinda Tait, iRWA's legal counsel Lorena Ramirez, and Dr. Bian Boyer traveled to Geneva to carry out due diligence on a work valued at $150 million. The intra-uterine birth of Salvador Dalí, the work iRWA is in the process of tokenizing, carefully curated by Tomio Leimo, whose dedication to preserving the stories surrounding this extraordinary work was evident throughout. Also present was Tigress Tai, who sits on iRWA's advisory panel, where she serves as the ecosystem's art consultant on surrealism, working under the name Asset Trip 32. She and Mazi from Zot Island covers the NFT space, formed the panel. Having that expertise in the room during due diligence on a Dalí's work is not incidental. It is exactly the kind of specialist knowledge that separates serious tokenization from superficial asset digitization.
And the relevance to iRWA is not just that it is a valuable asset. It is what kind of asset it is.
A Salvador Dali's painting is not a treasury bill. The value embedded in it is cultural, historical, emotional, the kind of value that no traditional financial system has ever had a framework to properly recognize or transfer. iRWA's mission is to preserve and unlock the value of intangible real-world assets for future generations. The Geneva Treaty was that mission in practice.
And as you mentioned already, Octagram, builders with 16 years of real-world development experience, have also joined the iRWA ecosystem this month. That is the difference between infrastructure building and infrastructure being used. And we received an interesting question. I'd love you to cover, Maryam. So how does an individual in South Africa or somewhere else participate, and how can they benefit their own community?
Oh, thank you for the question. The honest answer is participation starts with what you bring. iRWA is not a platform where you just sign up and receive passive rewards. It's an ecosystem where the value you contribute is the starting point for how value flows back. If you have a creative work, a community project, a piece of cultural heritage, that is the conversation. And when an asset is tokenized through iRWA, the value it generates is designed to flow back to the community it belongs to, not extract from it. That is the structural difference between what we are building and most of what we have discussed in this episode. Find us on LinkedIn, let's talk. And in an episode about trust, there's something fitting about the iRWA story for this month, being about showing up in person, in a room, in front of a work of art, and asking the hard questions about how its value gets preserved for future generations.
What takeaways from May and June?
First, if you hold any assets on a crypto platform that operates in the EU, check whether it's MiCA licensed. By the time you hear this, the transition period has ended. Unlicensed platforms are either winding down or in breach of EU law. The practical effect for users could be suspended withdrawals, forced migrations, or simply the platform going dark. Do not wait for an email that may not come through.
Second, the StablR hack is a reminder that words stablecoin and stable are not the same thing. Regulatory frameworks, including the UK's new approach and MiCA, exist precisely to enforce the standards that make stability real rather than assumed. When you use a stablecoin for anything that matters, understanding who issued it and what regulatory framework they operate under is not a technical detail. It is a basic question of whether your money is actually safe.
Third, the ZCash vulnerability story is not really about ZCash. It's about the fact that AI is now a tool powerful enough to find critical flaws in complex systems that human experts miss for years. That capability is available to white hat researchers. It's also available to everyone else. Every protocol, every smart contract, every digital asset system is going to need to treat proactive AI-assisted security auditing as a standard practice rather than an optional extra. The gap between we reviewed this thoroughly and we reviewed this with the best tools currently available has got much wider.
Fourth, and this is the one I want to close on. The numbers this month tell a story underneath the security exodus. 930,000 reward assets holders, 859% growth since early 2025. Ondo crossed $1 billion in assets on its platform. These are not paused by the security stories, they are running in parallel. The market is maturing, and that maturation includes learning, sometimes painfully, what standards actually need to look like. That is not a contradiction. It is what a real industry looks like when it is growing up.
Trust is not given, it's built. This month showed both what happens when it breaks and why it is worth building properly. That is the signal for June 2026. Next month, we will be covering the major stories as they develop, but as always, not just reporting them, analyzing them, and giving you the insight that actually matter. If something is happening in your world, a project, a regulatorship, a deal, send it to us. We want to hear from the people building in this space, not just the institutions announcing from it.
And I'm particularly curious to see what the European market actually looks like in July once the dust settles after MiCA.
If this episode made you think, share it with someone who needs to hear it, especially the people in your life who still think crypto and stablecoin mean the same thing.
And if you have a question you're trying to understand in this space, send it to us. Find us on LinkedIn. We are iRWA. See you in July.
See you.